Okay. We are live-ish.
We're live-ish, yeah.
um, I'm Robin Sheridan with Compass in Seattle.
And I am Kyle Bergquist from Primary Residential Mortgage.
So we're not sitting next to you, my friend, like sitting next to each other, but I'm glad we're able to do this. We did try to do Facebook Live this morning with a split screen. We had some technical difficulties, really my fault. We're going to do it this way, which is good. So I guess since we last met, there's been, a number of changes.
Yeah, I mean, we could say since yesterday. Like if we had met on Monday, right? You could say, oh my goodness, it's totally different now.
Yeah.
It's the markets and everything, the dynamics, and just there's so many factors at play right now that everything is changing so fast that, at least for myself, and I'm sure the same is true for you, Robin, that it's just trying to stay up on top of things. Like, okay, what is this new policy came through? What does it mean, right? This is how the markets are behaving. What does it mean? Here's the new Fed stimulus package. What does it mean? There are so many things that are changing so fast, and these aren't just like little tiny nuance things. These are foundational building blocks to our industries that are changing, and that's what makes it so hard just to keep up with things.
Yeah.
So
Brutal.
yeah, I think we're here to talk a little bit about some of these things. So I guess, what's obviously there's a lot new in real estate, but go ahead.
Well, I think I was watching this from a different area. Our governor on Monday evening did institute a mandate telling us to stay home. Essentially a shelter in place that they have in some other states. What is it? California, New York, maybe Illinois. I don't know. Again, it's changing constantly. So that basically delineated a list of people that were essential and non-essential. And you and I did talk about this. It was fairly comprehensive, but there's some gray areas that we're still working through.
Mhm.
Is essential.
Yes, banking's essential. So we are still here.
Yes, and real estate brokers like me are not essential. I know there is a push from the National Association to get real estate agents deemed so. I have mixed feelings about that. I want everyone to stay safe and healthy. So that's really, really what's most important to me right now.
Yeah. Some of the other players, I think this is one of the big things that I think surprises people as they go throughout the process, is they think, I have my lender and I have my realtor and I'm I'm good to go. And it's like, sure, but there's about 20 other people also involved, just by the way.
A lot of other people. Yeah. And well, we talked about that a little bit. I mean, some of the essential workers, well, just real estate aside, like doctors, nurses, pharmacists, mental health professionals, morticians, community health workers, those are all essential. And in the financial sort of sector, um, financial services, banks, lenders, and appraisers, which was a really big one for anyone going through a real estate transaction right now.
Yeah. I think first big question for you, Robin, is if real estate agents aren't essential, what happens to all the, I guess there's sort of two parts to that, right? You have people who are in contract and moving forward, and then you have people, maybe sellers that have not accepted a contract or buyers that have not made an offer yet. So can you distinguish a little bit about sort of the path forward for each group there, in contract or not in contract?
Yeah, I will tell you, I'll just use my own personal business as an example. I anticipated this was going to happen. And in the last week, I've sort of hunkered down, doing, very few showings. And I have 3 listings that were sort of going to be coming up here back to back to back. I was trying to stagger them as best as possible. And I had conversations with each of those clients over the last week that I did not advise listing right now, because I honestly didn't know what would happen with those listings if we went into a shelter in place situation. I didn't know if
Yeah.
the market would tick up. I didn't know if they would just languish on market and it would look bad, ultimately for their listing, or if anybody would tour them. Because what I did notice last week was that my buyers, one by one, started to drop out and say we're going to sit out for a little bit until the market stabilizes. And my sellers became increasingly anxious to move forward very, very quickly because they anticipated the market was changing too dramatically and they wanted to get their houses on the market. But with buyers dropping out, the tours and showings just dipped down to almost nothing. And although
Yeah.
were listed in the last week or so, sold, if they were priced properly, and that's really important, of course, sold quite quickly with few showings. It was going to be 0 showings in a short
Yeah.
period. I just couldn't advise anyone to do that when they couldn't expose their property. I can't do open houses as of almost 2 weeks ago.
And that was a brokerage mandate for open houses. That wasn't Northwest MLS, correct?
MLS disabled the open house function.
Oh, really?
Yeah. So some people were putting it. I mean, it's become very controversial. Some people
Yeah.
are using open houses in their agent remarks. I was not going to open houses, doing open houses. I want to stay healthy and I want my kids to be healthy. So
Right.
so it was pretty controversial, but yeah, they disabled that feature. So it pretty much nullified open houses. But I did see some signs around Seattle, very few, but I did see some. And people
Yeah.
virtual open houses as well, which was the safe way to go. So it wasn't, I just felt like I couldn't market my clients' properties properly. They weren't going to get the exposure that they needed.
Yeah. I've heard a lot of things. And I think the biggest sort of disclaimer that we almost need to make is there are so many big things changing so fast that there's still a lot of dust in the air, if you will, that needs to settle before we have any really clear guidance on like, here's how this is going to work out. Therefore, now that we know what we're playing with, now that we know what the ingredients are that we're playing with, we'll know sort of what how things are going to shake out on the back end, right? So there's, but I had heard the Northwest MLS, for all intents and purposes, was hitting the pause button on not in contract. So not in contract buyers are sort of, that's fine, right? There's no real reporting or recording of like who's in the buyer pool right now, but there are sellers. And I heard that one of the big things when buyers are looking at listings is that, what's the days on market? And so right now we're in a 2-week freeze. And I heard the Northwest MLS was going to hit pause on the days on market ticker for all these houses so that, let's say it goes 2 weeks, and then it gets extended another 2 weeks. Buyers aren't going to come back to the market in a month or two and be like, oh, wow, this house has been sitting for, a month and a half. What's wrong with it? It'll say, no, it's only been there for 15 days. Even if it has been technically on the market for a month and a half, they will remove the days where no one was supposed to be looking at the house or making offers.
Yeah, I saw yesterday from the MLS that they were exploring the idea of suspending the days.
Yeah.
I didn't see a notice. I mean, they simply should. I didn't see a notice this morning of that. So I didn't find that to be 100% clear. It is the right now is to suspend the days on market, because if the clock is ticking with 4 people who listed their houses, I mean, that's just unfortunate that simply nobody can see them. I would just take the key box off, because you don't want someone tramping through houses.
Right.
Stay home. I did notice, though, in looking at the stats this morning, there were a number of canceled listings and temporarily off-market listings, and you can pull something off market for, I think, 45 days without the days on market ticking. But in the past 30 days, there were 100 canceled listings and over 40
wow,
temporarily off markets, which is extraordinary.
Yeah. Wow. Yeah. So let's talk about some of the other people involved. I don't know if there's real guidance. So in contract, people are still moving forward. If you're not in contract, you're not moving forward. We've hit the pause button.
Yeah.
But
anyway,
if you're in contract and moving forward, it's not just a lender or realtor involved. You have an inspector, you have an appraiser, you have title, escrow, you have, I'm trying to think. There's so many different people.
They've allowed now remote notarization.
Notaries. Yeah.
We issued an emergency order yesterday, which is active for 30 days, right? That you can do remote notarization because you kind of
Yeah.
agree when you're actually signing your closing documents,
Yeah.
right? So I understand that for appraisers, they have relaxed some of the requirements because they are deemed essential. So they can do what, like a drive-by appraisal,
Yeah, there's lots of little, again, there hasn't been any clear guidance on this. What I heard yesterday was that Fannie and Freddie were going to allow sellers to take pictures of the inside of their house, send them to the appraiser. The appraiser will do a drive-by, kind of get an idea of the exterior of the house, combine that with pictures of the inside, and they'll be able to put an appraisal report together that way. But that only applied to loans with 15% or more down. And I don't know if it's been officially approved that this is an okay method, but it looks like this is, at least for 15% plus down transactions, it may be on the horizon.
Why do you think for 15%? Is it because those people can like adjust their ratio more easily, or?
I don't know why they picked 15 versus 20 or 25%. There's the argument would be 25% is the least risky, because there's no mortgage insurance, and at that point the borrower has so much equity into the house, they're very unlikely to default. And if they ever did, there's enough equity left over that the lender would make their money back. They wouldn't lose any. 20% is actually kind of a spike in risk because it's the least amount of down payment that doesn't require mortgage insurance. So there's no safeguards. And so 20% gets you out of mortgage insurance, but also means it's really risky to the lender compared to 15%, if you will. Even though it's less money down, you have mortgage insurance guaranteeing the lender against any losses that they may occur if the seller defaults. So why they picked 15, I could only guess that it was, it's enough equity where you're not kind of splitting hairs between, is it 5% down or is it 4% or 6%, right? Or because that's a really big down payment threshold. And so there's a little bit of room for error with the overall equity or loan to value in the house. And it still has some safeguards in place because you still have mortgage insurance on the 15%. And it just encompasses more transactions than 25% does. So that'd be my guess why they picked 15%. I have no idea. And again, I don't even know if that's what they settled on. For all I know, it'll come back out tomorrow and they'll say, no, this applies, but for 25%.
Honestly, the whole thing makes me nervous because there's such a vast difference in seeing the inside of a home. I mean, things can look very, very different once you're inside them. And
Absolutely.
It's one of the reasons I really try to tour active listings around my in-contract listings so that when appraisal time does come, I can say, hey, that looks like it might be comparable, but that place is really beat up inside. You simply cannot see it in the photos.
Yeah.
Comparison. Yeah.
So I don't know, and it may be, how do I say, they may say, hey, this is limited. Like there has to be you have to document a really good reason for why you're doing the appraisal this way. So there's still lots to be, figured out for that. And then even more, it's like, okay, well, what happens to the person who's putting 5% down? Do you need a full appraisal? Does the appraiser have to go in there and do it? Are the appraisers willing to go into people's houses? Are sellers willing to have people in their houses? It doesn't really help to shelter in place if you just bring a whole bunch of people into your house. All right. So it's a gray area. It looks like ultimately appraisers are going to be deemed essential and will be able to continue operating, but in what capacity, I think remains to be seen. I think the important thing is that this is only for the handful of transactions that, I would say it's for the people who got in contract the week before this lockdown happened, right? Because anything before that probably already had the appraisal done. So it's not like this is applying to just thousands and thousands of transactions. It's just a handful of like, okay, well, what do we do with the guy who got in contract on Monday, you know, a couple hours before Inslee's mandate here, right?
And home inspectors.
Home inspect, super important, right?
Are super important. And I was looking for guidance on this and kind of looking through everything I've seen over the past few days. I probably received like 50 emails trying to clarify different aspects of the mandate. But I don't think they can do it in right now, unless it's
Yeah. Which, you know, for a home inspector, they're super essential because if you're buying a house, you have to make sure that the house will be standard. You're not buying a money pit house, right? Like you don't want to sink 50,000 into your house because its foundation is cracking or something catastrophic is happening, right?
I did notice that the last week, the new active listings, for the most part, offered a seller's inspection to avoid people lingering in the home.
Because and just to clarify, because if buyers are in charge of the inspection, if you have 10 buyers wanting to offer on a house, that could be upwards of at least 10 pre-inspections plus an additional inspection. So there's, you know, by putting the inspection in the seller's hands, it reduces the amount of foot traffic or inspectors coming through the house, right?
Or, I mean, and most of the inspectors didn't want to be doing them anyway this past week because they didn't want to be lingering in the home with a bunch of people. Sellers didn't want people lingering in their home either. And I mean, it also, if it wasn't a popular home, I mean, most things stopped having review dates a few days ago too. So
Yeah.
if the home sold quickly without a seller inspection and without a buyer doing a pre-inspection, then you would have an inspection contingency. And then where are you, right?
Yeah.
You simply can't really inspect right now. As far as I can understand, I mean, I think that you can figure out a way maybe to do something virtually, not
FaceTime inspection.
Yeah, I think that would be really, really difficult.
Yeah.
About that this morning. I really want more clarity about it because I just simply don't know what you would do. I think most people this past few days probably accepted the seller's inspection and moved forward without an inspection contingency.
Yeah, I think how would you summarize the real estate side of things right now as of today, Wednesday morning?
I think as of today, you can pretty much say the market is standing still.
Yeah.
It's just standing still.
And
honestly.
And I think it's fair to say that no one has any clue. If you were to say, okay, well, what's it going to look like in 3 or 6 months? I don't think anyone has any credible idea of what it's going to look like after it all comes out, because we don't even know what the economy is going to look like after all this is said and done.
I think that's true. I've had a lot of different emotions about this, of course, right? Honestly, I'm really thankful to be spending time with my kids and to feel like I have a decent home and life. And a lot of people are like, it's going to come like roaring back here in a few weeks' time. It's very optimistic to think that. I know that I have a lot of clients, especially my sellers, that are like waiting for the very minute they can list their house. So
Yeah.
I'm going to have like probably a crush like of listings. And we'll see what buyer confidence looks like at that point.
Yeah, I think that's, so anytime there's a crisis, you want to use comparable situations. The unfortunate part is that there's no comparable scenario for what we're going through right now. But if you look at May of 2018, there was a 2-week period where so many sellers hit the market that it caused prices to stall out. And then the Seattle Times would sort of write about it. And it's sort of a herd mentality, right? Where as soon as it got published that there was lots of sellers and housing prices stalled, more buyers held back because they wanted to wait to see what the bottom was. So if this is truly the case, where there's going to be a flood of sellers that want to list the day after quarantines are lifted because they want to get ahead of whatever, right? Then, you know, it would make sense that the market would not open up well after the pause is lifted, because there's going to be a flood of supply. And I don't know if the demand is necessarily going to come back to the market quite as quickly.
Yeah, I would say that's probably true. I think people will kind of wait to see what happens, what rates look like. You know, I mean, I know a lot of people lost a lot of money in the last few weeks, so
Yeah.
that's been hard for people. That with regard to that and rates, and you mentioned a little while ago, you know, somebody with 5% down. I do want to talk about Monday before the mandate. I know that I spent probably 6 hours on phone calls that day when the secondary markets were falling apart. So if you
Yeah.
explain that to people, because that really did impact lending, if you feel comfortable.
Yeah. And I'm going to try and share my screen so that people can see
Oh, that would be cool.
what we see. So here's something we can't do on Facebook Live, right? So here, let me.
Screen, we just never do it.
Oh, okay.
I don't. I mean, I'm.
So here we go. Can you see my screen?
I don't. Oh, look at you.
So if we go to markets overview, and I think this is the most important thing to kind of see, right?
Yeah, I've seen this. Yeah.
So each of we'll remove all the moving averages. Hold on. So 200-day, 100-day, 50, and 25. Those are important because they're technical trading levels. But when there's so much chaos, they really don't matter. No one cares. And so each candlestick represents 1 day of trading, right? So this is January 2nd. That's January 3rd, January 6th. Well, then we had the weekend, January 6th, 7, 8, right? So you can see what a normal market looks like. As the price of this is the Fannie Mae, which one are we on? 2.5% coupon.
Yeah.
As the price of the coupon increases, the interest rate that borrowers need to pay to attract investors to the coupon decreases, right? So as the price of this coupon increases, mortgage interest rates fall, and vice versa. As the price decreases, mortgage interest rates rise.
Mm-hmm.
Okay, we on the same page?
Same line.
Okay, good. So this is what normal trading looks like. You have candlesticks that might range in a given day 20 basis points, you know, from top to bottom. And from the beginning of January to the beginning of March, so the first 2 months of the year, the candlestick was the price of the Fannie Mae mortgage coupon was slowly increasing. Well, then we get to right about here, February 20th, is when coronavirus really became pretty widespread in China and Wuhan. And even though it wasn't in the US, there was a lot of money. So here's the mortgage bond. So February 20th, if we go to the S&P and we look at this chart, we can go to where's February 20th, right? So you can see right there is when all the fears over coronavirus over in China started causing the stock market to sell out. And so you can see the stock market declining starting February 20th. You go back to the mortgage bond, you can see February 20th, the mortgage bond increasing. And that's because investors are pulling their money out of the higher risk, higher return stock market and putting it into the lower risk, lower return bond market. So we have a couple weeks here where interest rates were in the low threes and even the high twos, depending on some borrower and property profiles.
Mm-hmm.
So interest rates were so low, the lowest they'd ever been, that it made sense for almost every single person in America to try and refinance, which is what happened. Oh, sorry, what's that?
That really overwhelmed you.
It was pretty chaotic. I think there was a 2-week time period where I logged 133 hours. It was very busy. It was one of those times where it's like I write one email and 10 more show up. I take one phone call and 5 more voicemails. Or it was just like this is crazy. But then we get to this point here, and this is when now we're beginning of March. This is when I don't know when the first case was reported. It was here in Kirkland, right? So it was here in Seattle.
Actually, but it was before this period. And it was just that one man who had come back from Wuhan.
Yeah.
And that was like 2 months ago at this point. It was a while ago. It was right around Valentine's Day, I want to be like. Maybe they were up 2 months ago, but it was a while ago.
Okay. Well, it started, so here, like right around here is when it became widespread. Coronavirus really started spreading in America. But we'd had this run of really low interest rates and so many mortgage loan originations that it goes back to supply and demand. There was about $1 trillion in mortgage loan originations over this 2-week span right here, that even though demand had increased for safer assets like mortgage-backed securities, the supply was far outpacing the demand to buy up these mortgage-backed securities. And the secondary markets, you can see right here, this was a Monday morning. And then here, I think, was Thursday afternoon. From here to here is about a 300-point drop. Interest rates went from, we'll say 3% to about 4.5%, because the secondary markets were like, oh God, there is way too much supply. This absolutely cannot happen. Not only was the market correcting, but banks were starting to say, we're not accepting applications for refinance. We simply have too many refinances. A lot of the wholesale lenders, this is what is happening now, is that a lot of people are selling out of equities. They've been selling out of mortgage bonds. They've been, because of the volatility that you can see here, and they've just been holding on to cash. They've been going to straight dollars. And I think the US dollar hit a 12-year high in value the other day because so many people are just selling out of everything and holding dollars. And so we've hit liquidity issues now. Now we have liquidity issues. And we've seen it starting to percolate into our industry this past week, where some of the there's Fannie Mae, Freddie Mac, and Ginnie Mae. Those are the government-sponsored entities who buy conventional loans, FHA, VA, and USDA loans. So those account for about 80% of the overall loan volume in America, but that remaining 20%, jumbo loans, non-conforming loans, the no MI loans, those are non-conforming loans. And if you're a trader on the secondary markets and you're looking to go to the safest asset possible, mortgages are safer than a lot of other things, but then you got to dial it in even more. And you say, okay, well, which mortgages are the safest mortgages to buy? Is it a 5% down, no MI loan offered through, pick a wholesale lender, right? I think, wholesale lenders would be Caliber, Redwoods, Everbank, AIG, Merrill Lynch. Like there's a lot of Merrill Lynch, Bank of America, Chase Bank, Wells Fargo. They all have wholesale lending, and they have, even though the Fed has said, hey, we're going to start buying mortgage-backed securities, they're not buying those mortgage-backed securities. So a lot of the wholesale lenders were like, we are no longer doing these non-QM loans. And overnight, we got some press releases from some wholesale lenders saying, we're shutting it off. We're not going to originate any of these non-QM because there's literally no market for it. We cannot sell these. Everyone wants the safest asset that there is, which is 10-year treasury bonds or just flat out cash. Yeah. And so you can see every trading day might be 20 basis points here. Over the last 2 weeks, we've been seeing swings. These lines are called wicks. We've been seeing multiple 100 points per day. This was last Friday. It was literally a 320-point swing per day that ended down 20 points. So it was up a few hundred, down a few hundred, and then back essentially at unchanged levels. And then you go to the next day, right? This is the 20th. So what's this? Friday, I guess, right? Yeah, Friday the 20th. And we started here. We dropped a few hundred points, rose, got it all back, rose like 300 points. So there's just been so much volatility and so many people sitting on the sidelines that even this mortgage bond, with where people are putting their investing dollars, they're buying the safest possible mortgage tranches available on the secondary markets, which is conforming loans, 20% down, single family residence. So we've seen the price of the mortgage bond increase to record levels. The problem is this only applies to $300,000 loans, 800 credit scores, 20% equity. No one's buying anything else. And so there's no liquidity, and mortgage interest rates have not reflected this change in market because everyone is just sitting on the sidelines.
Yeah.
So this year I had to put out, we have a I don't know, sizable branch, is 22 full-time employees. And it's like, what this means is like, think of like a development where there's 50 houses or 100 houses, right? But for whatever reason, one person has a friend who just loves their house. Every house is valued at $500,000. And this one friend says, I will buy, I know you're not even looking to sell your house, but I'll buy your house for $1 million. Is the market for that neighborhood $1 million? No, it's really one person talking to one other person, bidding up the price of what could be perceived as the market, when the reality is the market is still down here somewhere because there's no liquidity. This is one person buying one kind of loan from Fannie Mae or Freddie Mac, selling that type of loan. And so we have major liquidity problems right now. And with the with the volatility in the mortgage bond, even lock desks, they have to hedge, because no VP of secondary markets wants to get caught pricing things to the market and then have the market drop 200 points the next half hour and be stuck with 500 loans that are now unsellable at market prices, right? And so there's volatility hedges in place. There are, even though the prices increase, it only applies to a certain type of loan. It's really fascinating. So probably way more than you bargained for when you asked what's going on with interest rates, but this is what we're seeing. It is absolute chaos on the secondary markets, where every single day is a month, maybe even 2 months worth of trading activity in a given day. And a lot of the money just ends up on the sidelines. And though the price is increased, it's only applying to one specific type of bond.
Right. Well, practically speaking, for me on Monday, I got a call from one lender in the morning saying their loan program is gone.
There you go.
Now the following day, and we have to close this today. And so it was a very long day. And then as soon as that call, I started to think, okay, I have got another buyer in contract with an exotic loan. Like be affected as well, probably funded, in this manner. And I texted the other lender, and she called me immediately and said, well, I wasn't going to call you yet, but like, oh my gosh. But I'm just asking you because I managed to close one.
Mm-hmm.
Thank goodness. And it was a day I won't forget because I've never spoken to the CEO of a banking institution before Monday.
Wow, good for you. Way to get your answers, or way to get your needs met.
I also have to give credit to the lender who sort of arranged all of this. Made it happen. But the other people managed to pivot into a different loan program. So are you having success with people whose programs did disappear overnight, essentially being able to pivot?
Well, there's a handful of people that you pick one of these 20% wholesale lenders because they're just offering better pricing, and you're like, okay, we're going to roll with these guys because the interest rate's a little bit better, right? They could have gone with Fannie, Freddie, or Ginnie, but they weren't offering the better interest rates. So you pick SunTrust is a really good example. They had really good interest rates over the last week or so. And so we have a handful of people that were doing SunTrust. Now, SunTrust they haven't stopped doing business yet, as far as I know. But let's say they did, we'd be able to roll those people over into a Fannie or Freddie loan and just say, hey, sorry, we lost the investor on this one. The investor's tightening their pockets. They're not originating new loans. But your loan can be underwritten to Fannie Freddie guidelines, and therefore we're going to underwrite it to those guidelines. Your new pricing is this because your new loan program is this, right? So you can pivot some people. There are other loans that are very specific non-QM loans, so non-qualified mortgage. That's sorry, I forgot what I meant. Non-qualified mortgage, which means that they in no way, shape, or form are applicable to Fannie or Freddie. One of them that we ended up losing was a $900,000 loan, 10% down with no mortgage insurance. First of all, Fannie and Freddie, they don't go up to $900,000. They don't do 10%. I mean, they do 10% down, but they don't go to 900,000. And if you only do 10% down, you're required to have mortgage insurance. Well, for this borrower, if they had mortgage insurance, then their debt to income ratios are higher, right? So on a number of different levels, it was sort of like, we can't pivot this person because their loan amount is too high. They can't afford the mortgage insurance debt to income ratio wise. There's no other options for this borrower because this was the only lender offering, only investor offering this type of product. But obviously that product is riskier than 20% down, 300,000, whatever, right? And so those are the first types of products to get kind of squeezed in a liquidity crunch.
It's the time to keep your financing contingency in place.
Yes. Don't waive those.
Always time to do that. Sometimes you just can't.
Yeah.
Okay, well, I mean, there's still options for people out there. Maybe not the exotic programs that we were using more frequently over the past year or so, but there's
there's definitely still options. I think there's a couple of things I really want to make sure and leave people with. One, there's a liquidity crunch similar to, we had a liquidity crunch back in 2008 and 2009. The difference, but the reason why is really, really important. The reason why right now is not because everyone's lost tons of money. I mean, people have lost money with the stock market declining, but that's not the primary reason. The primary reason is because banks and a lot of institutions remember 2009 and they're saying, hey, if we want to stay solvent, we got to tighten the pockets really quickly, right? So they're just, they haven't lost their cash. They're just reluctant to spend their cash. They want to keep it in-house. Okay. Versus 2009, people just lost their cash. So there was a liquidity problem because there was actually no money. There was no liquidity if there needed to be liquidity. Yeah. And the other thing is that the Federal Reserve, I think last night they just kind of buttoned up their stimulus package. And even prior to the stimulus package between the Senate and the White House last night, the Federal Reserve, as of last week, they were buying hundreds of billions of dollars of mortgage bonds, and those mortgage bonds that they're buying are the safer mortgage bonds. It started off with one type of coupon at Fannie Mae, right? And they've slowly been expanding them to all the mortgage coupons, high balance coupons, conforming balance coupons, the 2.5%, 3%, 3.5%, 4% coupons, the Govy coupons. So they are still buying mortgage-backed securities from Ginnie Mae, Freddie Mac, Fannie Mae, and so those loan programs are still as solid as ever because those are the first ones to get the funding from the Fed. So there's no liquidity issues on a majority of the loans. It's really the non-conforming out-of-the-box stuff that's starting to get squeezed right now.
I mean, I think that affects some of the people in Seattle, of course, because, we have these people that are young and they have really good incomes, but they haven't saved a lot of money. And so they're using these programs with a very little down, right? But to buy more substantial homes. So,
yeah,
build up more reserves basically to put a greater down payment, which is.
Yeah, for sure.
I did note that Freddie and Fannie have some, they're allowing people some leeway on their mortgage payments, as I understand it.
I think, if you lose your job, and I've even heard stories of servicers being proactive and calling their borrowers and asking, hey, did you lose your job? Are you having any financial hardship? And offering a 3-month reprieve on their mortgage payments, which is amazing. I love the proactiveness. I think that's really important because I think what people forget is that they kind of think it's me versus them type of thing. Like it's me versus the mortgage company. It's like, no one wants you to default. And so, but because people, think understand that. They just don't call, and therefore they default or miss a payment or whatever. Most mortgage servicers, most mortgage banks, everyone wants you to be as upfront and transparent as possible. And so if you do have any sort of financial hardship, there are mechanisms being put in place to re-securitize and re-amortize a lot of these loans to give people a 3-month break from mortgage payments.
Yeah.
But it requires the borrower who is suffering a hardship to be proactive if their servicer hasn't called them first. Call your servicer. There's a lot of options out there because no one wants what happened in 2008 to happen again.
It's ridiculous. Banks, I remember when I got into this business, those short sales and those bank sales, and how they went very poorly because banks aren't in the business of selling people's homes.
They don't want homes. No, they don't. The last thing they want is a balance sheet line item of, $100 billion of tangible assets that they need to sell,
Yeah.
right? They are in the business of lending money, and they want to stay in the money side of business.
Right.
And so they're going to do everything they possibly can. Even though they short sold a lot of homes and covered some of their losses, they didn't come out on top. I mean, there was a lot of banks that went under.
Yeah.
And it's far less expensive to just re-securitize the loan than it is to have someone default on the loan.
Yeah. What was I going to say about that as well? I think, and just also in that same vein, that the tax deadline got pushed back.
Yeah, July 15th, right?
It's August 15th.
Is it August 15th? Yeah.
Pretty great. So, I mean, I think people are feeling really uncomfortable, and they just have to take a look at their finances, call their mortgage companies, take a deep breath. Even vacations and things, like, people have relaxed their policies around that. I have a vacation scheduled for July, and I don't know what it looks like. So I just emailed them yesterday. It's in Europe, and said, what's your policy given what's going on?
Yeah.
Get there. And they said, we've really significantly relaxed our policies with regard to cancellations, and we'll give you, all this extra time basically to make that decision.
Yeah.
Which was great.
Good. Yeah, it's a very quickly evolving world that we live in, and we're doing our best to stay on top of it and provide the guidance that we can reasonably provide.
Yeah. It's I don't know. It's very serious. I mean, we're over 2,000 cases here now. I mean, New York has completely blown us out of the water at this point.
Yeah.
Just stay home. Right?
Stay home, stay safe. Remember what's most important in life, and focus on what you can focus on, and try not to let the intangibles or things that are out of your control bring you down too much. Because I think at the end of the day, if people make a list, they say family, health, my home, my kids,
Agreed.
and that's, we're lucky that we haven't lost any of those, right? Or most of us.
Yeah.
Most of us haven't lost those. I
just think, and for you too, with young kids, we will never have this much time with our kids again. And I, as you know, I'm, a single mom here, and it's hard because we work full time, and I don't get to see them as much as I'd like. And now I'm just cherishing the time that I get with them. So that is a spot for me.
Yeah, good. Silver linings.
Yeah, definitely. Well, it was awesome to see you. I think we covered quite a bit, and I would say, since we're going to post this on Facebook and we didn't do a live version, that let's keep a track of the comments, and I will link to the mortgage relief, and I'll link to the mandate so that people can take a look at those things.
Cool.
And we can just answer questions in the comments.
All right, that sounds good. Thanks, Robin. Great to see you.
Good to see you. Okay, I'm going to stop this recording. Yeah.